Most people understand what a mortgage is, thanks to the very fact that several folks have one. But does one knowledge the mortgage itself came about? Here is a few basic history on the mortgage and wherever it came from. In the starting, a mortgage was simply a conveyance of land for a fee. The buyer paid the vendor a group rate, with no interest, and the seller would sign over the land to the buyer. There were sometimes conditions that had to be met before the land would be the property of the customer, similar to these days, but usually it was based upon the assumption that the land would turn out the cash to pay back the vendor. So, a mortgage was written thanks to this truth, and therefore the mortgage stayed in impact in spite of if the land made or not. But this previous arrangement was terribly lopsided in this: the vendor of the property, or the investor who was holding the deed to the land, had absolute power over it and could do no matter they likable, including mercantilism, it not allowing payment, refusing payoff, and other issues which caused major problems for the buyer, who held no ground at all. With time, and blatant abuse of the mortgage system, the courts began to uphold additional of the buyer's rights so they'd additional to face on once it came to owning their land. Eventually, they were allowed to demand the deed be free and clear upon the payoff. Interest safe and confirm that their cash was paid. A mortgage secret for first-time buyers: it pays to shop for additional. It's not simple to shop for a primary home, therefore here's a suggestion that will be surprising: rather than shopping for one residence, purchase many. What I am suggesting has nothing to try and do with late-night infomercials or books that promise quick and straightforward wealth from property. Instead, several first-time consumers will enjoy a stimulating quirk within the mortgage system. When you hear folks bring up real estate financing, they typically divide mortgages into two categories: loans for owner-occupants and costlier and more durable loans for investors. Investment financing is for consumers who don't physically reside at a property. Owner-occupant loans area unit for homes, the places wherever we tend to reside. Night, the phone rings and therefore the automobile is put. But there's a wrinkle: owner-occupant funding with very little down and low rates is often on the market for the acquisition of quite a single-family house. Normally you'll be able to get owner-occupant funding for properties with 1 to 4 units as long as you utilize one as your prime residence. In different words, your standing as associate in nursing owner-occupant permits you to shop for quite simply a house or condominium. You can truly purchase property that produces rent and will increase your tax deductions. When you purchase properties with 2 to 4 units, the globe of property funding changes. Lenders can apply most of the rent to your financial gain for qualification functions. This means you'll be able to borrow additional, and additionally that you simply can offset loan prices with the rents such properties turn out. Suppose you buy a property with 4 units. You'll live in one and rent the others. Each of the 3 rental units has a fair market rental of $1,000. In this state of affairs you are probably to induce 2 edges. First, the lender will count some portion of the rent, say 3/4, as income for you when determining your qualification standards. In other words, $2,250 a month will be added to your income. $1,000 x 3 units equals $3,000. $3,000 times 75% equals $2,250. Why $2,250 and not the whole $3,000? Because the investor assumes you'll need vacancies, repairs, insurance, taxes and different prices for the rental units. The investor additionally assumes one thing else: for tax functions, 3/4 of the property in this example will be investment real estate. When reported your financial gain taxes, you may list your rents and prices for these units. One of these costs are depreciation, an accounting device that will lower your taxes but take nothing in cash from your pocket. When lenders see depreciation, they add back that price once viewing your monthly financial gain. The result is that your effective monthly income for loan qualification purposes will increase even more than $2,250 in this example. Buying 2, 3 and 4 unit properties can make great sense, especially for first-time buyers. You'll have help meeting monthly mortgage payments, especially in the first few years of ownership, the time that's often the most difficult. Later on, if you choose to maneuver, you'll be able to sell the property. Otherwise you may prefer to keep it and simply lend the unit had been your residence. As with all investments, neither annual financial gain nor rising property values may be secure. Some owners may feel uncomfortable having tenants so close, and there's always the potential for insufficient rents, excess vacancies, and big repairs. Also, beware of going too far. While up to 4 units is okay, 5 units automatically classifies the property as investment real estate under the guidelines for most loan programs, a title which means you cannot use owner-occupant funding albeit you reside on the property. The good news, though, is that as an owner-occupant and also as a landlord you'll learn a lot about the practicalities of real estate investing. Real estate ownership requires ongoing maintenance and oversight. As associate in nursing owner-occupant with many units, you'll learn on the job about making repairs, dealing with tenants, hiring contractors, and maintaining property. These area unit valuable lessons which may offer financial gain and wealth over a period of time. In fact, many folks who've become triple crown in property usually started with only one little property, owner-occupant funding with very little down, and 2 to 4 units.